Right now, a healthy 40-year-old parent is sitting at a kitchen table, looking at a colorful chart that promises financial freedom. The agent across from them points to a line that only goes up, backed by a 0% floor that guarantees they will never lose a penny to the stock market. It feels like the ultimate safety net for their family. So they sign the contract, committing $500 a month to a product called Indexed Universal Life, IUL for short. But there is a silent math problem hidden inside that folder. Fast forward 20 years, and that same parent might discover that the contract didn't protect them from losing money. It just changed who took it. To understand how a product that brought in $3.8 billion last year can quietly drain your savings while the market is completely flat, you have to look at the three numbers both the agents and the critics refuse to put on the same page. That $3.8 billion figure comes from LIMRA, the life insurance industry's own research association. And here is the math that should make you pause. In a year when the stock market rises 24%, an IUL account might be credited 9. In a year when the market falls 19%, the account is credited 0. That sounds like protection, downside covered, upside captured. But in that same 0% year, the money in the account can still go down. Not because of the market, because of something printed deep inside the contract, something the illustration on the kitchen table almost never shows. Over the next few minutes, you will see the arithmetic that neither the agents who sell IUL nor the influencers who attack it ever put on one screen. Both sides leave out the same three numbers. By the end of this video, you will know all three. So what is Indexed Universal Life? In plain language, strip away the branding and it is two things bolted together. The first is life insurance, a death benefit that pays your family if you die. The second is a savings-style account called cash value that is meant to grow over time. Every month, your premium walks in the door and gets split. One slice pays for the pure insurance. The industry calls this the cost of insurance. Another slice pays fees and administrative charges. Whatever is left drips into your cash value. Here is the part that surprises most people. That cash value is never actually invested in the stock market. Not $1 of it buys a stock. Instead, the insurance company credits your account with interest based on how an index, usually the S&P 500, performs. To make that possible, the insurer typically buys options on the index. You do not get a portfolio, you get a formula. And formulas have settings. 3 settings decide everything: the floor, the cap, and the participation rate. The floor is the minimum you can be credited in a bad year, almost always 0%. The market drops 19%, your credited rate is 0. The cap is the maximum you can be credited in a good year. According to carrier rate sheets published in early 2025, typical S&P 500 caps run between 8 and 12%. The market soars 24%, you get your cap and not a penny more. The participation rate decides how much of the index move even counts before the cap is applied. So far, this can sound like a reasonable trade. Give up some of the upside, eliminate the downside, sleep at night, protect the family. That is exactly how it is presented at the kitchen table. Now run the numbers the presentation skips. Picture a healthy 40-year-old parent. $500,000 of coverage. A typical IUL premium for that profile lands somewhere around $500 a month. Over 20 years, that is $120,000 walking in the door. Where does it actually go? In the early years, a meaningful slice goes to commissions and premium loads. And every single month, the cost of insurance comes out, which brings up the first quiet fact. That cost is not fixed. It is recalculated as you age. At 40, the charge for each $1,000 of coverage is small. At 60, it is several times larger. At 70, larger still. The contract allows this. It is not a scandal. It is the design. But it changes the story of that 0% floor completely. Because here is quiet fact number 2, the one from the opening. In a year when the index falls and your credited rate is 0, the policy charges do not take the year off. The cost of insurance still comes out of your cash value. The administrative fees still come out, so the floor protects you from the market, but not from the contract. 0% credited minus 12 months of charges equals a negative year. The market did not lose your money, the policy spent it. Ask yourself, have you ever seen an IUL illustration with a negative year printed on it? That question is not rhetorical. It bothered regulators enough that the National Association of Insurance Commissioners, the NAIC, the body that coordinates insurance rules across all 50 states, had to step in. Twice. Actuarial Guideline 49, and then its stricter sequel, AG 49A, exist for one reason. IUL illustrations were painting futures too bright to be probable, and some companies kept engineering products around the limits. When a product needs 2 rounds of regulation just to keep its own sales projections honest, that tells you something about the sales projections. Quick pause before the biggest number of all. Anyone sitting across from a person selling any policy, IUL, whole life, term, anything, deserves to walk in with the right questions. There is a short, free list called the Insurance Loophole Checklist that covers every question in this video and a few more, and the link is in the pinned comment right below. Grab it before your next insurance conversation. Now, the third number both sides leave out, dividends. When you hear that the S&P 500 returned about 10% a year on average, that figure includes dividends, the cash that companies pay their shareholders, historically around 2% a year, according to S&P Dow Jones indices. Index funds collect those dividends and reinvest them. IUL crediting formulas do not. The formula tracks the price of the index, not the total return. You are credited on the movement, but the dividend, roughly a fifth of the market's long-term return, is simply not part of your equation. 2% sounds small. Compound it. Take $100,000. Grow it at 9% for 20 years. Call that the market with dividends, and it reaches about $560,000. Grow it at 7%, the market without dividends, and it reaches about $387,000. The difference is roughly $173,000 from dividends alone, before the cap has trimmed a single good year, before 1 month of policy charges. That is the number that never appears in the glossy folder, and rarely in the angry videos either. And one more assumption is hiding in plain sight, the cap itself. That 8 to 12% cap in the quote, in most contracts it is not guaranteed. The insurer is allowed to lower it after the ink dries, year by year, and the guaranteed minimum cap in many policies sits down around 3 or 4%. Decades of a family's money riding on settings that the other side of the table is allowed to change. This is not theoretical. In 2018, Transamerica agreed to a settlement reported at roughly $88 million in a class action brought by universal life policyholders after the company raised the internal charges on policies people had held for years. The company admitted no wrongdoing. The policyholders learned who holds the dials. There is also the question of what happens when a family simply cannot keep up. IUL premiums are flexible on paper, that is the universal part of the name, but flexibility cuts both ways. Skip payments while the internal charges keep rising, and the policy quietly eats its own cash value to stay alive. Until one day it cannot, and the coverage collapses exactly when it was supposed to be protecting someone. Walk away in the early years instead, and surrender charges, exit penalties written into the contract, take their bite on the way out. Term insurance ends softly. Stop paying, coverage stops, nothing owed. A policy built as a savings vehicle punishes the exit. And life, as every parent knows, does not always follow the illustration. So what does the alternative math look like? Run the comparison for that same 40-year-old parent. A 20-year term policy, pure insurance, no cash value, no formulas, for $500,000 of coverage typically costs a healthy applicant around $30 a month. The IUL was $500. The difference is $470 a month. Put that difference into a plain index fund averaging 7%, a deliberately modest assumption below the market's long-term average, and after 20 years it compounds to roughly $244,000. Sitting in an account with your name on it. No caps, no participation rates, dividends included. Is that a guarantee? No, markets do not sign contracts. Some years that account will fall, and there is no floor to catch it. That is the honest version of the trade. But notice what just happened. For the first time in this entire conversation, both options are sitting on the same page, in the same dollars. That is the page no illustration will ever print for you. Now picture the moment this actually gets decided. It is not in a video. It is at your kitchen table, with a friendly, probably genuinely well-meaning agent, a folder of colorful charts, and your kids asleep down the hall. In that moment, you are not really being sold a product. You are being sold a feeling that if something happens to you, the people you love are safe. That feeling is legitimate. It is the entire reason life insurance exists. The only question is whether this particular contract is the cheapest, cleanest way to buy that safety for your family. So before anything gets signed, 4 questions. 1, what is the guaranteed minimum cap? Not today's cap, the one written in the contract. 2, show this illustration again using only the guaranteed assumptions. Watch how different that page looks. 3, what will the cost of insurance be at 60 and at 70? 4, if the payments stop in year 10, what exactly does this policy hand back? A good agent will answer all 4, calmly, in writing. Hesitation is also an answer. And to be fair, IUL is not a scam, and it is not illegal. For some high-income households that have already filled every retirement account available to them, there are planners who make a serious case for it as a tax tool. But that is a niche product. It is being sold like a staple. Many families discover, years later, that they only ever needed the simple version. Cover the risk, keep the difference, own the growth. Which brings this back to where it started. $3.8 billion new dollars a year, flowing into a product most buyers cannot explain. Sold on a floor that does not stop the charges, a cap the seller is allowed to move, and an average return that quietly leaves the dividends out. None of that is hidden, exactly. It is all in the contract, and contracts reward the side that reads them. So the number that matters now is not LIMRA's $3.8 billion. It is the set of numbers in the illustration sitting in your drawer, or the one that will land on your kitchen table someday. The guaranteed cap, the charges at 70, the value if you walk away. At the start of this video, a 9% cap with a 0% floor sounded like protection. Now you know what it really is, a formula with settings controlled by someone else. Protection is what happens when you understand the settings, and as of today, you do.